This video is about 5 risky things that people do in planning for retirement or in retirement when it comes to investing and their finances. None of these things really seem risky, and we're even encouraged to do some of them, but they can certainly add to risk in retirement. Hi, I'm Camille Gaines here, and on my website, retirecertain.com, I write about and I talk about investing. I'm not trying to sell you wealth management services. A lot of the YouTube channels are financial advisors that have some great information. I'm a person that really loves investing. I saw really early on the importance of investing in my 20s. I've been investing ever since then, and it's a passion of mine. And thank you for listening to me talk about investing here. The very first mistake or risk that I think a lot of people do in planning for retirement and in retirement itself when it comes to investing is looking at annualized returns and not annual returns. Annualized returns are what we typically see if we look at a fund or we maybe meet with an advisor and they show us annualized returns, and that's what's happened over a certain number of years, maybe 5 years, maybe 10 years, and I can pretty much assure you that however many number of years it is, it's the way that the return will look the best if it relates to an investment or a product of any type, which pretty much anything you're looking at does. So by looking at that annualized return, you're not able to see the volatility that occurs inside of that fund or that portfolio. If you look at annual returns though versus annualized return, that average that's lumped together, look at those annual returns by year, that will often paint a really different story. I learned this a couple of decades ago when I was analyzing investment strategies, and I really liked, and I love still, to zero in on what's happening every year with this investment. Now, certain accounts I don't want a lot of fluctuation in, and I think the older we get, and especially in retirement, we don't want that volatility. We want the best returns we can get with the least amount of volatility. And when we look at those annual returns, we can see how much an investment fluctuates, goes up and down from year to year. You may have an asset that went down 50% one year and up 50% the next year, and so on and so forth over the years. But those are really wide swings in the value of your investments, and this is something you may not want, and you just don't see it when you look at those averaged annualized returns. So that's the very first thing I think is risky, because it sets you up, I think, to not be prepared emotionally for the swings that can occur in your investments. And when we are not prepared emotionally for those swings up and down in the value of our assets, well, that's when we make mistakes. We sell low and we buy high, and it just is better to have a really good feel, and then that helps us select investments and investment strategies better that align with our acceptable risk and the amount of fluctuation that we want in any investment. Because when we get in our 50s, 60s, we're no longer looking at things as long-term investments. We're no longer approaching investing from a place of, I'm holding on for the long term, 30 years I'll have enough to retire. No, we've got a different thing going on. So look at those annual returns. Okay, that's number one. Let me look at my notes here. Okay, here's a really good one, especially these days, and that is, remember to check the real return. And the mistake that investors make is not remembering to check that real return. What do I mean by real return? That's the return after inflation is factored in. Now, we typically and frequently think of this with income-related investments. So if a bond, for example, is yielding 3% and inflation is 4%, we've got a negative return on that bond. And so this is happening a lot. We really and truly are getting negative returns on fixed asset investments such as bonds because inflation has gotten higher. And even for years, even when inflation was supposedly around 2% and we were getting a 2% interest, we're still negative after we pay taxes, especially, or breaking even. So always look at the real return, and that's just the return that you get minus the amount of inflation, because that inflation is just eating up that return that we're getting. All right, the next mistake is, this is a big one, and I've talked about this a lot here. Consider that the next 10 years will be different than the past 10 years. We forget to do this. There's something called recency bias. You've heard me talk about it here before in behavioral finance. That just means that we think that's what has happened lately is going to keep happening over the next few years. It feels that way. We do this in life. It's not just with our money. It's just how our brains are wired. And we think that what has happened lately is going to keep happening. That's certainly, well, it could be the case with our finances, but there can also be clues in the economic environment that tell us this is no longer going to be the case. As you've heard me talk about here before, for example, if we're near the end of a 40-year interest rate decline, well, it's going to change. Things are going to be different going forward because mathematically interest rates can't go lower. And interest rates going down make stocks go up and bonds go up. And I'm sort of saying that, there's some explanation around that, but I'm just going to summarize it and say that they have a positive influence on the returns of stocks and bonds. Declining interest rates do. So when we know they can't go down anymore, we've got to know that that's a really big threat for our portfolios that are invested in stocks and bonds to keep doing over the next few years what they've done over the past few years. We can also just look at history. If we look at 1999, 2000, and we had the end of that strong bull market, and a lot of investors had made money in stocks and bonds, portfolios, traditional portfolios, we can look over the next 10 years and see how terrible the stock market performed. Negative returns after 10 years, over that 10-year period. The annualized return was almost 1% for that entire decade, and that's from the S&P 500. Now bonds, yes, they did go up, but the increase in bonds doesn't offset the decrease in stocks because, number one, they don't go down the stocks tend to go down more than the bonds go up, number one, but also just because most investors have a much smaller percent of their portfolio invested in bonds than they do in stocks. So that it doesn't come out where it works out, where bonds really do protect us during the time periods when stocks go down or those bear markets like we saw in the 2000s decade. So back to my point, we can't assume that the next 10 years will be like the past 10 years. We know for a fact, if we look at history, that's just not the case. And I'm using 10 years loosely. It could be 5 years, it could be 10 years, it could be 20 years. Everything is cyclical, and those cycles change what's going to happen with our investments, our returns, our assets, even our net worth, because real estate prices drop and that takes down our net worth right along with it. All right, let me look at my notes. The next risk that retirees, soon-to-be retirees, take on or do a thing that they do that is risky is not considering all types of risk. All right, no pun intended there. So almost everybody just thinks of stock market risk. They think about bear markets, they worry about bear markets, and that's important to plan for bear markets. They are a reality of stock market investing. But there's so many other types of risk. There's inflation risk, as we've seen recently. There's liability risk. I have come up with 14 different types of risk. If you want to see some of my other videos on all the many types of risk that we need to invest around so that we secure our financial future, particularly important the older that we get. All right, let me take a look here. I've got one more, and that is not owning assets that do well during different economic situations. So, for example, a lot of investors, most investors, still just own a portfolio of stocks and bonds because this is what has worked really brilliantly for the past 4 decades, many decades. It's worked really well, but in particular, the last decade. And a lot of investors don't own other assets that do well during financial crisis or during high inflation. So it's super important to own assets that will perform no matter what's happening. Now, I don't load up on all assets for every economic condition or environment and always hold them. I invest based on what's happening, and I actually use a strategy based on historical data that has performed well. So I'm not saying that you should always own all these assets, but if you only own stocks and bonds, take a look at what is likely to happen, what risks are looming, and ask yourself if you are protected for the other things, that the other risks, the other economic conditions that can happen, that might happen, that are likely sometimes to happen based on where we are right now. Remember, retire certain.